Hi, my name is Z, the founder of Aion Finance. Today we're going to be doing an analysis on the Middle East tensions and how that affects the stock market and the options market, where we'll look at historical occurrences of Middle East conflict and taking a look at the options marketplace to see what are the best historical risk-reward strategies during those times. Let's begin. As an introduction, Aion Finance is a platform where we build models to discover what are the best performing strategies in the past during a similar time frame to give us the best risk reward for strategies to employ today. We had overnight news on the Israeli strikes on Iran nuclear sites. This is kind of a horrible occurrence, and the markets obviously are very shook by this particular outcome. So you see overnight we had a pretty precipitous sell-off, about 100 handles on the futures, though we have rebounded quite a bit throughout the day and overnight before some more headlines and a little bit of jitteriness into the close. So the question we're going to answer today is, what are the best performing option strategies during times of conflict? And the way we're going to answer this is by looking at the first trading session after a Middle East conflict. Every Middle East conflict that occurred since 2016, June. I start most of my analyses starting from June 2016 is because that's when weeklies were introduced with SPY, which drastically increased the number of data points you can have in an analysis. What we're going to do is for every one of those days, we're going to start buying calls and puts at every 30-minute interval. So there should be about 13, 30-minute intervals within a day. And we're going to buy every call and put that is 1, 4, 7, 14, 28, 42 days to expiration multiplied by 10, 30, 50, 70 delta. And what we're going to do is we're going to take those options and we're going to take them into expiration and we're going to calculate their P&L. And then we're going to aggregate the results by days to expiration and delta. And the whole idea is to understand what call / put DTE / delta combination is best that outperforms and which combination underperforms. And we can start building strategies around the historical performance of these options. So I took to ChatGPT, which gave me a list of, I think, 13 different occurrences of Middle East tension. And here's a list of all of them. I'm going to read them out to you. And let's hop into the platform and take a look at the model. So here is the platform, and the model I built is to find the top 1,000 data points. So 1,000 data. The reason why I put 1,000 is because it's more than the total number of data points that are actually in this analysis. So it'll just grab every point in this analysis with the most similar wicks. Because we are grabbing every data point in the analysis, this is not going to matter. This matching part will not matter. Between 2016 June 1st and 2025, this is the first time we've had a conflict this year, and it's the first day of trade during Middle East tensions. What we're going to do is we're going to analyze the options pricing for SPY. So let's take a look at the results of that analysis. So first thing to see is that we have a visualization of all the different times that this actually occurred in history, and you'll see that they don't always have an adverse effect on the market. So sometimes you see like a couple day drop here is actually one of the bigger drops. If you look elsewhere, we've had situations where there was no drop at all and the market just kind of kept on chugging along. In fact, you actually kind of see this in the VIX for that day. So for example, in this day, the first day, the range of the VIX was only 15 to almost 16, which is a very small range. And most of the occurrences actually had very low VIX. I mean, we had the historically low VIX environment during 2017, 2018, and it's not until you get to 2023 where you actually get a kind of like a bump in VIX, and that kind of makes sense because you are also in the throes of a bear market, so you had a higher baseline for the VIX at that particular time. So anyways, that's kind of like something that's kind of interesting to note. Now looking at the actual results. So the way you read this graph is what is the expected what is the average P&L for every one of these products, calls and put, 1, 10, 1 DT, 10 delta put, 30, 50, 70, and on the call side, what is their average performance in the past for those 13 days. So you'll see here that in the 104 occurrences of buying this particular call option during those 13 days, we had an average P&L of 38.6% with a win rate of 21%, which means that if you just blindly went up there and bought a call option on one of those 13 days at 1 DT 50 delta, if there existed a 1 DT 50 delta option to buy, you will be losing approximately 40% of your money at expiration. You can see the results of that by clicking on this, and you'll see every instance of it happening, and what is the product you bought, what is the price at underlying, and what is your P&L at expiration. So this will give you a little bit more transparency into what happens in these numbers. So that's what the top number is, and the bottom is actually just without the filter of those 13 days, what happened in general in the last 10 years. What is the average expected P&L? So if you were to do that for a 1 DT 50 delta call over the last 10 years, you would have made approximately 1.2%. It's kind of like a baseline measure of what is your expectation is, because over the last 10 years, we've been in a bull market. Like you will very likely see very negative values for puts, but that doesn't mean that you should always be selling puts. This is like a especially good time to be selling puts. So it's more like a baseline reading. So what you can see here is that first things first, everything on the put side is very negative, even more negative than the baseline. In fact, you were never assigned on a 10 delta puts at 14 days and 42 days. So I think what the platform is telling is that the fears of a World War III or a mass escalation that is priced in the market generally has not materialized, which makes a lot of sense because we haven't had World War III yet. So these kind of lotto tickets at the bottom, these massive out the money insurance policies really did not materialize. In fact, it seems like it is actually a good time to buy the dip and go long. Now, what's really interesting here is that it tells you not that we should be going long, but exactly what products you should be, what strikes, what expirations you should be looking at in order to go long. So for example, if you go long, but you bought the 1 DT 50 delta call, you would be losing money. Whereas if you started moving farther and farther out in expiration, your likelihood of success is a lot higher and you'll actually be making money, right? So some of the best options to buy is, this like, if you were to be bullish, some of the best options to buy are, this 50% here, which is 7 days to recognize 50% at 30 delta. I think that is, pretty good. In fact, you're recognizing 50 days. Well, there's a 66 days here, but it takes you 28 days to kind of recognize that 66% increase in the P&L. So it's actually better to get lower DTE because you're making more money faster, right? But what you can do is you can kind of offset the credit, the debit that you need to pay for that particular option by selling something that has a negative value but on the call side as well. So maybe you could be selling one of the for a 10 delta 4 DT calls, and you're going to be making money on the short and making money on the long theoretically. So this is how you can take this information and build complex structures that give you really, really good risk reward. So for example, something that you could be looking at is, say you short one 10 delta 4 DT and you long one 7 delta 7 DTE 30 delta. So let's just take a look at the options chain and see what the risk reward is there. So we have 7 DTE. Sorry, I'm just looking at all chains, so it's kind of messy, but you can go something like this, right? Sorry, maybe like 10. So it's a buck 50 to make $6. That's a pretty good risk reward if you ask me. That's 7 to that's these two right here. You can even do something better. You can do like 7, and then you can say you long a 30 delta, and you can short a 4 delta. Sorry, not delta, days to expiration, sorry. And then you can short one that is 10, and you'll be paying a little bit more, but what that gives you is it gives you a couple more expirations to work with. So you can sell, maybe you're at the day of expiration and this is worth absolutely nothing. You can maybe roll it out and get a little bit more credit, and take your cost basis down more. Or if this thing, the product just kind of blasts through your all of this entire structure, you're very happy, you can take profit on that, a pretty large profit on that. So yeah, you can, that's something, if I were to be bullish, that's something that I would play on the call side. On the put side, this gives you kind of like carte blanche to sell options that is very far out. I would do it responsibly, not use too much margin, not use too much leverage, because the past is not an indication of future performance. It is just a guide. So you could be the one unlucky occurrence, and you know how selling options goes. Just one very large loss, it allows for very large losses. So some paying a debit on the call side, I think, is a little bit more preferable to me than going out and selling puts. And just me personally, in order for me to get bullish, I probably need to see it start, taking out at least this high, and also, buying into the 6,000 handle on the SPX just doesn't seem like very smart. I want to see it as support. But yeah, this is kind of just a look at the platform, what it's showing us. If you like this kind of content, please like and subscribe and give a thumbs up to the video. I am looking to do a Fed video for next Wednesday to take a look at all previous occurrences on the Fed. So please stay tuned. Maybe hit the notification bell if you want to see the content drop. Okay, thanks.